In this video, I am going to show you how you can reduce your taxes by over 50% by simply creating a tax plan. As a licensed CPA, I have created tax plans that have cut $90,000 tax bills down to $38,000, $200,000 tax bills down to $100,000, and $700,000 tax bills down to just $300,000, and so on. Filing your taxes without a plan is like carrying a bucket of water full of holes, except it's not water leaking out, it's your hard-earned money leaking out to the government every single year. And 90% of the people I talk to are leaking out more money than they actually have to, impacting their ability to save money, build wealth, invest, or just pay down their bills. So today I am going to help you fix those leaks by breaking down what exactly tax planning is, what a proper tax plan really looks like, and a very simple process that you can follow to start creating your own tax plan today. As a licensed CPA that tax plans every day at mycpacoach.com. So if that sounds good to you, go ahead and save this video, hit the like button below, and let's go ahead and jump in. All right, so let's break this down. What exactly is a tax plan? According to Cornell Law, tax planning is when you use the tax law to key phrase, pay the least amount of money in taxes possible. This is very important because some people and even tax professionals are so scared of implementing strategies to legally reduce their taxes, which is crazy because the IRS is very clear that tax avoidance is not some criminal offense. In fact, they explicitly state that it is your right to reduce, avoid, or minimize your taxes by legitimate means, such as shaping and pre-planning events to reduce your tax liability within the parameters of the law. And fortunately, the tax code consists of over 70,000 pages of tax deductions, tax credits, and other incentives that you can use to help you pay less money in taxes, which means you don't have to lie, cheat, conceal information, or commit tax fraud to reduce your taxes. We already have a very big coupon book available to us in the tax code that actually makes reducing our taxes very simple. But sadly, most people cannot take advantage of those incentives, not because they're not eligible, but simply because they do not know that they actually exist. And that's where tax planning comes into play. A proper tax plan will identify which parts of the tax law are most relevant to you and that can be used to reduce your own taxes. But how exactly is that done? Well, let's go back to our original definition here, and then I'll show you how this works. So in the second sentence of the definition here, it states that tax planning consists of the analysis of the taxpayer's financial situation in order to pay the lowest amount of taxes. And this analysis should ideally examine things like your income level, the type of income you earn, your tax bracket, and most importantly, the amount of taxes you are expected to pay. In the perfect world, you would project your income out for the year and the amount of taxes you would pay on that income, which would be your starting place to position yourself to start working that tax bill down. So start by taking all of your income sources, like your W-2 income, your self-employment income, any dividends you have, or interest income, and so on, and run it through a tax calculator to project your expected tax liability, or just have your CPA do this for you. And beyond that, also be sure to analyze your unique facts and circumstances like your filing status, retirement goals, whether you plan to buy or rent your home, your business structure, any family members that you may support, as well as any big purchases or investments you plan to make. This is absolutely critical to your success here because usually the best tax planning opportunities are designed around your current circumstances. Your analysis might identify opportunities to save more money for retirement, hire your family members, optimize your entity structure, and so on, which is all based on your current set of circumstances. So the idea here is that before you start looking at different tax strategies, you need to be very clear about your current situation, your long-term financial goals, and your overall wealth strategy, which is very easy to lose sight of when you're looking at all of these different tax strategies. This will help you be crystal clear in what you're willing to do to reduce your taxes and what you're not willing to do, because it is very easy to make terrible financial decisions by throwing money at strategies that make absolutely no sense for you given your own financial objectives and risk tolerance. You don't want to follow cookie cutter tax advice that takes you away from your overall strategy. You should be seeking tailored tax advice that is within the realms of your long-term objectives. So in addition to analyzing your income, analyze yourself and what you're willing to do to not only reduce your taxes, but to build more wealth at the end of the day. That's the main goal. We cannot lose sight of that. And once you do that, then you can move on to my favorite part about tax planning, which can be summarized in one word: arrangement. This is where we arrange your financial situation to reduce your taxes in accordance with the tax law. So look, if you want to change your tax, you have to change your facts. If you are unhappy with how much money you owe at tax time, it is because the facts reported on your tax return resulted in a higher amount of taxes, period. And when it comes to tax planning, the analysis tells us the facts up front. But then the arrangement is what actually allows us to change those facts on that next tax return. With that said, what exact changes can we make to reduce our own taxes? Well, I'll show you some examples here in a moment, but on the highest level, it involves reducing the amount of taxable income you report on your return. Income tax is a tax on your income. So if you can report less income, you can pay less taxes. And to take this a step further, some types of income are actually taxed at lower rates than others. So even if you earn the same amount of income, you may be able to reduce your taxes by simply changing how that income is characterized. A lot of tax planning strategies focus on reducing your taxable income on paper or changing the characterization of that income to one that is subject to lower forms of income tax overall. And there are literally hundreds of legal strategies available for you to choose from, but as a CPA, I have boiled all of them down to 5 key areas. Number 1, converting everyday expenses into tax deductions, which is the lowest hanging fruit for most people. A lot of people pay for things that are in fact tax deductible, but simply fail to write off those expenses on their return. So if I wanted to reduce my own taxes, the very first thing I would do is take a detailed look at everything I'm paying for to see how it may qualify as a deduction, like my health expenses, my housing expenses, my meals, car expenses, travel, insurance, and so on. And for individuals that own a trade or business, you may actually be able to write off a portion of those expenses as legitimate business expenses. And even if you don't, for all taxpayers, you may be able to write off things like your medical expenses, your mortgage interest, your charitable donations, and more as itemized deductions when you file your individual return. Now, the second major thing I would do is explore opportunities to do number 2, make tax deductible investments, which may allow you to build more wealth while reducing your taxes at the same time. At my firm, I call this the tax reduction matrix because you can literally do this on repeat and reduce your taxes by however much you are willing to invest. So here's how it works in a nutshell. There are certain investments that the government wants people to make, and they incentivize these people to make these investments, like investing into real estate, businesses, energy, or charities, for example. So to get people to do these things, they reward investors with unique tax incentives like depreciation, depletion, charitable tax deductions, and Section 162 tax deductions, which virtually allow these people to write off almost anything that is ordinary and necessary for their business. For example, right now, many people are using 100% bonus depreciation to write off very large amounts of real estate they purchase, equipment, even cars, and more that ends up reducing significant amounts of income on their tax returns and their taxes. And if these assets help you earn more income and increase the value of your business or assets, you would effectively be increasing your wealth while reducing your taxes at the same time. The third key area you can exploit for tax savings is number 3, income shifting strategies, which allows taxpayers to shift their income to people or entities who are in lower tax brackets. This is where we see people hiring their children, their parents, or other family members who may be in very low tax brackets. By hiring them through our business, we are able to use the salary tax deduction to write off payments we make to them, while they report the income they receive at much lower tax rates, sometimes resulting in zero tax on their end. There might also be opportunities to shift income to management companies that are taxed differently to reduce your taxes. For example, if you're hiring family, a family management company might help you avoid Social Security and Medicare taxes on your children's wages. Or if you're in a very high tax bracket, you might benefit from splitting some of your income into a C corporation, which just has a flat 21% tax rate. You might even be able to shift income to yourself tax-free through things like the Augusta rule or tax-free reimbursement plans like medical reimbursement arrangements or dependent care assistance plans. These are all income shifting strategies, but should consider your unique circumstances as discussed earlier. The fourth major area is deferring income, which allows you to push income off of your tax return this year to the future where you may be in a lower tax bracket. People do this all the time by investing into various retirement and health savings plans like IRAs, HSAs, 401ks, and even pension plans. For example, to cut one of my clients' tax bills in half from $730,000, one of the biggest strategies we implemented was creating a cash balance plan, which allowed my client and her spouse to put more than $550,000 towards their retirement savings in 1 year and write off the entire amount. This is just one simple example of using a retirement plan, but there are several other asset classes that you can achieve similar results with. Key area number 5, choosing the best tax classification for your income. As I mentioned earlier, how your income is classified for tax purposes may result in higher or lower amounts of taxes. The IRS taxes different buckets of income differently, and from a tax planning perspective, we're interested in the bucket with the lowest tax rate possible. For example, long-term capital gains and qualified dividends are taxed at anywhere from 0 to 20%, while short-term capital gains and ordinary dividends are taxed up to 37%. So if the opportunity presents itself, you might opt for the lower tax rate here. Self-employment income, like income from entities taxed as sole proprietors or partnerships, are subject to a 15.3% self-employment tax, while corporations like S Corps and C Corps are not subject to this tax. So depending on the circumstances, it might make sense for you to optimize your entity structure to protect yourself from this tax. Plus, there are other tax elections you can make with the IRS that may grant you the ability to take more tax deductions or use them in more beneficial ways. For example, the real estate professional tax status allows real estate investors to use rental losses against their earned income. The trader tax status allows day traders the ability to take business deductions against their investment gains. I can go on and on here, but the idea here is to choose the best way to structure your income from a tax perspective, which ends up reducing your tax exposure and the amount of taxes you pay. So look at every opportunity to arrange your facts, and once you have, compile all of this together into an action plan, and even more importantly, make sure that you actually implement that plan before the year ends. At our firm, we compile a comprehensive tax plan report that details how much money we will save from our plan, the exact strategies we need to take advantage of, as well as the implementation steps to make all of this a reality. And if you need help creating and implementing a tax plan before it is too late, just apply to work with my team today at mycpacoach.com.